stock at the right time.
Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. You're watching Indian Open. I'm Neeraj Shah and wish you and all your loved ones a very happy Dhanteras. Let's go straight to the headlines at this hour. US allows 8 nations, including India, to keep on importing crude from Iran, even as restrictions on other countries kick in from today. The Central Information Commission issues show cause notice to RBI Governor Ruchit Patel for not disclosing list of defaulters as mandated by the Supreme Court. Higher realizations and lower finance costs help ONGC meet estimates in the second quarter, while a rise in net interest income and Axis Bank's quarterly earnings. And the country's largest public sector lender, SBI, is expected to post higher retail growth and lower slippages when it comes out with its quarterly numbers today. Well, let's take a look at the trade setup for the day. It promises to be a day that will start off marginally lower, though I must say the cues or the macro cues seem to be positive. Now, what happened for our markets post-market hours on Friday, and it happened sometime around the US morning or afternoon, Donald Trump went down and said that we'll make a deal with China, and I think that it'll be a very fair deal for everybody. And he's mentioned that the two sides are getting very close or much closer to doing something. Now, frankly, a lot could happen between now and when the two leaders do meet in Argentina at the end of November. But the story is there on the Bloomberg Quint website, and it seems to be that there being certain diffusion of tension between the two sides, and that should only augur well for sentiment across the world. I must say, the US markets didn't react too positively in Friday's session. They came off a little bit in trade, and that's showing up in the rest of the Asian pack as well. So Nikkei is down about 1.28%. Shanghai very, very flat. Hang Seng too about 1.5% lower, and the SGX Nifty is indicating a downside on open about 1/3%. But you know, we've had such a good rally that you could probably expect a bit of a pause in that as well. But there are some short-term tailwinds for our markets. One, precisely what I said, the de-escalating of tensions between US and China, which is good news. Earnings season thus far has not been disappointing. In fact, Axis would only add further fuel to what is arguably a reasonably okay earnings season. Crude oil has corrected. The rupees firmed up meaningfully in the last 2 or 3 odd sessions. So all of that augurs well on the macro front. And frankly, despite all the news flow over the last few days, market watchers that we've spoken to over the weekend are very sanguine about the government RBI equation. So there are some short-term tailwinds for our markets. We've seen evidence of some of that in the bounce that we've seen from those 10,000, 10,015, 10,020 odd levels all the way to 10,555 right now. Let's wait and watch if this lasts or no. What's to be watched today? Of course, Iran sanctions kicking in and the impact that it has on crude prices as well. Though India has been granted a waiver, so from a macro perspective, it's okay. But what it does to crude prices would have a bearing on what happens on our markets as well. So this is something that everybody needs to monitor. And of course, the elections in the US, but that's something that we'll talk about in a couple of days from now. The stocks to watch today, and I thought there are a bunch of stocks that you should monitor, but I've chosen the top 3 or 4 that I thought were the most important. So SAIL, it is a strong quarter, but below estimates. That's the key thing. You will look at the reported numbers and think fabulous quarter, but it is below estimates. The revenues are up 22% at about 16,718, but the estimates were 16,442. A PAT at 553 crores versus an estimate of 699 crores. So very good quarter, but substantially below estimates. EBITDA too, the numbers marginally around 250 crores below estimates. It came in at about 2365 crores versus estimates of 2624 crores. And margins at 14.1 or 14.5% as you would calculate versus estimates of 16%. So all of these led to SAIL posting a very strong quarter, but below estimates. And it'll be interesting to see how the stock reacts in the session today and over the course of the next few days. But I'll not talk too much about it because I would want to talk about it a little bit later on first word. Axis Bank, again, I won't dwell too much on it because I'm sure we'll talk about it. The GDR reacted very positively. NI up about 15%, net profit up about 82%. GNPAs contracted, net NPAs contracted a bit. So all in all, the numbers looking picture perfect. Darshan, I'm sure we'll come in and talk about it more. But watch out for Axis Bank, could react positively today. I thought it was a weak quarter for Bombay Stock Exchange. It's a stock that has been beaten down. But if I just look at the numbers that have come out on a YOY basis, revenue is down 3%, PAT down 31%, EBITDA down 70%, margins contracted substantially. Even if you argue that it may not be an apples to apples comparison, looking at it, this business currently in the current scenario at YOY, the fact remains that a year ago, the margins were 29%. They've come in at 9%. Employee costs have jumped up substantially for them as well. Let's see. It's a stock that has been beaten down, as I said, but not the best of quarters, could react. And from amongst the new listings, Adani Gas. We'll talk about it a bit later on in the show, but do watch out for Adani Gas in the session today. As at about 10 a.m., I think, is when we'll get the first ticks. However, it's a packed first word, so let me jump straight to the to all the top stories that we're getting for you today. Have the US sanctions on Iranian crude lost the sting after 8 nations were allowed to continue importing from Iran? We speak to Peter McGuire about the impact. India's name on the list of exempted countries will put a smile on the faces of our fuel retailers who cheer in the second quarter. Summit tells us why. Shikha Sharma's penultimate quarter as Axis Bank CEO and MD has turned out to be a rather good one. With the trend hold till December is the question. Russian tries and weighs in on that. State-run steelmaker SAIL may have posted a profit in the second quarter, but brokerage is still apprehensive about some factors. I take you through the fine print, and then Yash comes in to talk about why sugar mill owners are hoping to taste sweet success after the government hiked ethanol prices, and it's got nothing to do with their existing stock. Why? But firstly, the big news, US sanctions on Iranian oil come into effect today, but the Trump administration has agreed to let 8 countries, including Japan, India and South Korea, keep buying oil from Iran. How does this impact crude supply dynamics across the globe? Let's discuss that with Peter McGuire, Chief Executive Officer at XM.com, joins us on the phone line from Sydney. Peter, good morning. Thanks so much for joining in. What do you think happens to crude prices in the near term with the sanctions kicking in?
Well, good morning. Look, I think it's fascinating to look at what happened in October. If we look at any sort of indication, Brent's down the best part of 17, WTI nearly 19%. We're about to hit a bear market territory, I think, sometime this week for both. And it seems to be in a free-fall position. So I think from a trader's perspective, all the longs have been cut. Bearish positions are ruling, and traders are doing very, very nicely out of it.
Okay. Peter, the fact that 8 countries have been allowed to continue importing oil from Iran. Now, one, what it does to those individual macros, that's separate because India, I'm sure, benefits out of this. But 2, do you reckon that in the next 1.5 months, there could be chances of significant volatility in crude prices? Or do you think all of these factors have been baked in already?
Well, I think first off, yes, I think the volatility is going to be a whipsaw. If any market's down 20% in a month, it gives some sort of indication. And we're not talking about a small little market. We're talking about one of the largest markets in the world being crude oil, 100 million barrels a day. And I think that you're leading up into this 1 month away till the next OPEC meeting. We've got the midterms coming this week. It's going to be massive news on a global footprint, really over the next, say, 6 to 10 trading sessions. And I think that that's going to add considerable volatility to the market. And where the US dollar, I look at that 96.5 at the moment, the US dollar index. It just seems to be so many moving parts at the moment. I think volatility is going to be a big headline number moving into November.
One last question. What's the near-term target for crude oil that you have?
Well, I think if you're going to look over the next week, I think we're going to be down probably another 2 or 3%. I wouldn't be surprised to see, possibly a $70 handle for Brent being breached, and may look at a $61 or $60 for WTI. Let's just see what happens as far as sanctions. Let's see what US dollar does, and of course midterms, which is going to be a very fascinating run. So I don't rule out President Trump. He seems to pull rabbits out of the hat, so he might do it again this time.
Peter, leave it at that. Thanks so much for joining and giving us that perspective. Well, I guess the midterms are probably as important for all of you who have cousins, and I do in the US. I think the WhatsApp groups are filled with messages about going out there and vote. I won't talk about which side they are veering towards, but I'm sure a lot of us are experiencing this. It's not just an election that is important to the US, but for a lot of us who got our brethren out there in the US, we kind of get indirectly involved in these elections as well. But crude oil, the important point, talking point. In fact, the next piece is also on companies that get impacted by crude oil. The country's largest oil refiners did not live up to the market expectations in the second quarter earnings. IOC, BPCL as well as HPCL witnessed sharp declines in EBITDA to the tune of 46% 38 and 34% respectively. But operationally, where the results are bad as the headline number suggests, that's the question that we posed to Soumit Sarkar. He's standing by with a closer look at the quarter for all three OMCs. Morning, Soumit. Happy Dhanteras.
Good morning, Neeraj. Happy Dhanteras. Now, if you see, there's no doubt that the earnings were weak for all the three oil marketing companies, but they were not as bad as the headline EBITDA suggested. Now, if you see, for Indian Oil Corporation, its headline EBITDA dropped by nearly 46%. For BPCL, it dropped 38%, and for HPCL, it dropped 34%. But that was because of lower inventory gains and higher foreign exchange losses. Now, adjusting these two numbers, now if you see the core EBITDA, HPCL's core EBITDA dropped by only 5% as compared to a 34% drop suggested by the headline EBITDA. In fact, for BPCL, it has increased marginally by 0.7% compared to a drop shown by the headline EBITDA of close to 38%. Now, for Indian Oil Corporation, you can still see a 24% drop in its core EBITDA, but that was because of a one-time contribution that the company had to do towards superannuation benefits that lifted the company's employee costs, and that's the reason you're seeing this 24% drop. Now, what dragged the earnings? Well, it was a double whammy of lower inventory gains and higher foreign exchange losses. Now, Indian Oil Corporation's inventory gains dropped by nearly 44%, and its foreign exchange loss increased by nearly 45%. For BPCL, inventory gains dropped 46%, foreign exchange losses increased 32%. And for HPCL, its inventory gains dropped by nearly 33%, and its forex losses increased by nearly 65%. Now, if you see, refining crude and marketing fuels is the core operations of all the three oil marketing companies, that is Indian Oil Corporation, BPCL and HPCL. Now, if you see the refining business, now that has remained subdued for all the three oil marketing companies. For Indian Oil Corporation, the EBITDA losses expanded to 936 crore. BPCL's refining EBITDA fell to 644 crore, while for HPCL, the losses expanded to 285 crore. And for marketing business, only the Indian Oil Corporation's marketing segment saw some improvement, while for BPCL and HPCL, the marketing EBITDA declined compared to last quarter. Lastly, on the balance sheet side, if you see that debt, now that has increased for all the three oil marketing companies. For HPCL, it increased by 20%. For Bharat Petroleum, it increased by 32%, while for Indian Oil Corporation, compared to last quarter, the debt has increased by nearly 33%.
Soumit, crude oil prices have now eased from the levels that we saw in September quarter. So, will the third quarter be any better? How are the things looking going ahead?
Actually, yes, Brent crude has come off from $83 per barrel to now close to $73 per barrel. Now, this sharp fall in crude oil prices would lead to some inventory gains for the oil marketing companies, but the marketing segment, now that could outperform because of this sharp drop in crude oil prices. Now, if you see, earlier the marketing segment was expected to be weak for all the three oil marketing companies, and that was because government had asked them to absorb the 1 rupee cut in petrol and diesel prices. Now, they would have done this by lowering their gross marketing margins, but now this falling crude prices will help them recoup these losses as it increases the ability to increase the gross marketing margin. Now, if you see the gross marketing margin earned by all the three oil marketing companies on sale of every liter of petrol and diesel, now that has dropped by only 40 paise and 70 paise. Now, this is despite a 1 rupee cut. So, you can clearly see that they are able to increase the gross marketing margin because of falling crude prices. Now, that's a positive thing for all the three oil marketing companies, that they are able to recoup their losses on gross marketing margin front. Now, on the refining business, the Singapore gross refining margin, that is the Asian benchmark, now that has averaged lower at around $5.3 per barrel as against $6.1 per barrel compared to last quarter. But with falling crude oil prices, this could rebound. So we'll have to see how that pans out for the oil marketing companies for the rest of the year. For the rest of the quarters.
Yeah, well, you can very well say for the rest of the year as well, almost, if you take the calendar year into account. But Soumit, thanks for putting that into perspective. So, well, that's what's happened in the quarter gone by for the OMCs and what could happen in the quarter coming ahead as well. Well, what could happen in the quarter coming ahead for Axis Bank? Difficult to say, but it did post a significant uptick after the second quarter earnings. The GDR already jumped 7% after the private lender posted 82% growth in profit numbers. Darshan Mehta is standing by with the fine print of the numbers, not just the headline, and what brokerages are making of these numbers as well. Morning, Darshan. Happy Dhanteras.
Happy Dhanteras, Neeraj. Yeah, numbers were good. 7% growth on the 7% rise in the GDR indicates that probably we will also have a similar rise, probably even more, because we are much more liquid than what the GDR is. Basically, profit 82% was expected, but slightly better than what came out. Even the NII growth was decent. It came in at almost 15%, 5,230 crores versus our estimate of of 5150 crores. The other part was that the asset quality improved significantly. Now GNPA fell to 5.96 from 6.52, and then net NPA fell into almost 2.54 versus 3.09. So there is a positive trend that is there. Some of the factors that we need to watch out for: first of all, the core PPOP growth of 15% was driven by a beat on the NII. Lower slippages this time around and significant improvement in the NPA will certainly definitely benefit Axis Bank this time. Almost 1100 crores of the 28 crores was corporate slippages, and the management has indicated that the downgrade cycle is nearing an end. So that is something that should be taken out on the positive side. BB and below book has reduced significantly, indicating that the asset quality has improved significantly. And exposure to IL&FS, they said that was 830 crores, out of which 240 crores is fund based. So not that much concern that someone would have with an IndusInd Bank, which the exposure was over 3,000 crores. A lot of brokerages came out with notes. Most of them are positive. Some of them have raised the target price, but a consensus target price is coming in close to 750 because Nomura has raised the target price to 750. They're saying that the PPOP improvement and credit cost that will normalize is positive, and that will lead to an ROE expansion. CLSA has revised the target price to 750 from 690, and they're saying that the key positive was the moderation of slippages. They are positive on it. Credit cost to fall sharply from FY20 is what they are anticipating. Antique is saying that the last 2 quarter performance instills confidence in the corporate recovery cycle, and Deutsche Bank is maintaining a buy with a target price of 750, and credit costs they believe should fall materially from the 3rd quarter onwards. So overall on all fronts, I think it's a positive view from the brokerage side, from their numbers versus the estimate, from how the GDR reacted. So I think it's a given that Axis Bank will have a strong opening today.
Well, Darshan, thanks for putting that into perspective. That's our head of research, Darshan Mehta, talking about Axis Bank and what the stock could do in the session today. Well, difficult to... All we can say is the stock will likely start positive, and the GDR gave the impact thereof. When our guests come in, we'll talk to them about what's the extent of gains that we could see in Axis Bank in the session today. Could well turn out to be the stock of the day. Well, the other one that is an intriguing stock in the session today is SAIL. It's returned to profits in the September quarter. But let me just try and take a moment to explain why SAIL becomes very important as a stock in the session today. I'll just go across to the wall to try and tell you why this becomes a very important stock to monitor in the session today. Firstly, the numbers, and the numbers will come up on your screen in just moments from now. Just the reported numbers. I'm not giving them versus estimates, just the reported numbers, and then of course we'll get in all the finer points for SAIL in the session today as well. These are reported numbers. Revenues up about 22%. Bottom line, well, from a loss into the profit of 554 crores. So exceptional quarter on a reported basis for SAIL. It's a good quarter is all I'm trying to say, even though it's below estimates. EBITDA, well, up about 158% at 2365 crores, and margins at 14.1% versus 6.7%. Remember, in the previous quarter as well, SAIL had positive margins, or rather double-digit margins, about 15.5 or 16 odd percent. So the first half of this current fiscal, SAIL has posted some very good numbers. Now, what are the factors that you need to monitor when it comes to SAIL? Firstly, capacities have been upped over the last few years from 14 million tons to circa 21 million tons. So they have the capacity in place to produce more, and a better product mix and cost control will only aid margins. We are probably seeing the first signs of that in the half year gone thus far, and maybe that will only improve going ahead. Now, this is the note, that is the chart that I've borrowed from company data as well as Haitong Securities note, and they are talking about 2 charts. One is how the coke rate coming off will help SAIL in improving their margins, and then of course the better product mix and lower employee costs will help SAIL in a meaningful way in trying to improve their margins. I think those numbers will come up on your screen and you will see what I'm talking about. This is the employee cost as a percentage of sales, and look at what used to happen in the past. So FY13 employee cost as a percentage of sales, 19%, went up to 20.5%, 21.3%, 25%, then FY17 about 20.6%, FY18 that came down meaningfully, and the first 2 quarters, Q1 FY19 and Q2 FY19, something that I've calculated, 12.92%. So as you can see, there is a definitive downtrend in employee costs as a percentage of sales for SAIL. And when I spoke to experts, all of them said that the biggest bugbear for SAIL used to be employee costs, which used to be very high. If they're able to bring these down, then it's a big positive for SAIL. The other point is, the room to bring down the employee cost. Now, per ton, SAIL continues to pay substantially higher employee cost per ton compared to JSW Steel, which is fairly integrated as a player, converter of sorts, and Tata Steel as well. So what I'm trying to say is that it's not that SAIL will bring it down to these levels, but that even though they've done quite a bit of work, there's still room to improve their employee costs per ton of production, whether production goes up or whether the number of employees come off, or there are stricter cost controls as well. Other fact is better cash flows will help deleveraging. Now, there are no new capex plans for the next 3 years. And look at these charts, the interest coverage ratio. These are all estimates from brokerages, again from Haitong Securities. So the net debt numbers are expected to come down FY19, FY20, FY21. The net debt to equity will also taper off a little bit. And the interest coverage ratio, which was woefully low in the year of FY16, since then has moved up and is expected to reach even higher levels in the next 2 or 3 years. So the ground is set for SAIL to be able to do well. The problem is the analysts community split right down the middle. Now, if you look at the ANR, the number of buys versus the sells, 42% have buy ratings, 33% have sell ratings. And while the return potential is still about 20%, the only difference in why these brokerages have a difference in opinion is, one, the EBITDA estimates, and two, the multiple that you assign to the EBITDA estimates. So anywhere between 5 times to 6 times FY20 EV EBITDA multiples is what brokerages have assigned. And depending on the EBITDA estimates that you have, then the target prices differ from being as low as 70 rupees to as high as 120 rupees in certain cases as well. So brokerages split right down the middle. The question mark only is whether it can do well. However, just one point of caution. Remember, the numbers have been good, but below estimates, and brokerages have posted certain points that you should monitor, the key risks, if you will. The concerns remain. One, the ramp-up delays, if they come about this. I've borrowed from the Bank of America Merrill Lynch note that Nikki sent to me. The rise in employee costs, even though they're trying to control, the costs remain at elevated levels, as I showed in the previous chart, compared to JSW Steel and Tata Steel. And a product mix deterioration. If indeed the product mix deteriorates as opposed to improve, because a key factor for SAIL is that the product mix improves. And if that doesn't happen, that's a problem. And regulated relays for new iron ore mines, this would be a key concern as well. So you got to keep in mind that all is not hunky-dory. They're trying to improve meaningfully. Hopefully they can do that. Today's day, the numbers very good, but below estimates. Difficult to quite predict how well the stock could react. Keep in mind, it's already gained about 9 or 10% ahead of the numbers. So that's the other thing that you got to monitor in the session today. Okay, the last piece on First Word is on a sector that has really caught the fancy of a lot of not just retail traders, but institutional investors as well. Sugar. The government recently pushed up ethanol prices by as much as 25% for the current financial year. While the government's been doing its bit for the sugar industry for quite some time now, this one move is being seen as a game changer. Not that the mill owners are sitting with gallons of ethanol waiting for the right price. In fact, most of them are still building on or increasing their ethanol capacities. So how does all of this work for the space? What's changed? Yash Upadhyay is here to tell us all about it. Morning, Yash.
Morning, Neeraj. So typically, it has been sort of the last 1 month or two for sugar names, and they have kind of braced the kind of fall that we've seen in the markets, and that is because of these announcements. Firstly, the increase in the procurement price for ethanol for this current marketing year, that has been a key positive. Now, what this does for the companies is that first of all, it takes them approximately 60% more cane to produce ethanol as compared to producing sugar. So that turns out to be a conversion ratio of 1.6 times. Now, if you divide that 1.6 times with the revised ethanol prices, you arrive at the exact realization in sugar terms per kilogram. Now, what this means is that at 43.6 rupees, if you divide the conversion rate for C-heavy molasses, the realization in sugar terms per kilogram is about 27 rupees. But when you do the same process for B-heavy molasses and cane juice, the realizations go up significantly, almost 33 rupees when it comes to B-heavy molasses and almost 37 rupees when it comes for cane juice. That is significantly higher as compared to the all India average sugar realization, about 30 to 31 rupees per kilogram. Now, while this is a big positive and it is supposed to help when it comes to the bottom line, how would it stack up for a sugar company were it to produce more sugar as compared to what it does as of now? We take a illustrative example over here from our interactions with the industry experts, many of the sugar companies and analysts. So on a base of about 1,000 crores in FY18, assuming a minimum 5% top line growth, we could see that ideally in the last, let me start with the previous 2 years. So FY16, FY17, these are the years when sugar was more dominant. Close to 88% of their revenues came from sugar predominantly, whereas ethanol gave very less, almost 3% of the revenues. Now going forward, if the sugar companies were to produce more ethanol, say by about 5% to 10%, 15%, that would significantly improve their net profit margins, which are at the same time seen growing by about 10% to 15%. So on a base of about 1,000 crores, their net profit was about 50 crore rupees. That would go up to 105 crores in FY19, and by FY20 that number could jump up to as much as 165 crore rupees, and this is because of the revised ethanol prices. Now why does this happen? Sugar prices in the year of FY16 and FY18, they had gone down significantly due to surplus production. Now what that does is that it pulls down their margins. Now EBITDA margins for sugar tend to be in the range of lower single digits at most, and in years of surplus production that number could go down to negatives. Whereas ethanol, on the other hand, since the prices are fixed by the government at the start of the year, the margins are largely stable, and what this does is that it removes the cyclicality of earnings for the sugar mills and boosts their profitability, which we are seeing when it comes to the estimated numbers for FY19 and FY20. Now additionally, if you could get the next page up, yeah. So because of that, the sugar mills, they are expanding their capacity now, and most of them, like Dhampur Sugar, they are expanding their capacity by about 100 kiloliters per day, and that is expected to come on stream by the end of this month. EID Parry, DCM Shriram is expanding their capacity by 200 kiloliters per day. BCL Industries, Triveni Engineering, Shri Renuka, these are some of the names which are expanding their capacity to meet with this increased demand and the projected future growth in their bottom line. Now the realizations, however, would take about a year or so as these increased capacities come on stream, so that would be something to watch out for in the future. Also, there are multiple positives apart from that. So basically, the government is targeting about a 10% ethanol blending under the National Biofuel Program for by 2022. That number is projected to go up by 20% as of 2030 is what we understand. But clearly there is a demand-supply mismatch, because ISMA says that the all-India average for ethanol blending that stands at about 4% versus the current target of about 10%, which they plan to scale up to 20%. So there is a clear demand-supply mismatch, and because of that, there is a lot of scope. So for the current year alone, the OMCs, they have tendered in for about 50 crore liters of ethanol, about 48.5 coming from B-heavy molasses, and about 1.84 liters from the cane juice.
Right.
So since this is the case, if more cane is being diverted towards the production of ethanol, Neeraj, that would bring down the sugar production as well, because on an average, ISMA says that if this 50 crore liter of ethanol were to be produced, that would bring down the sugar recovery by about 2%, and that turns out to be a number of about 0.5 million tons. Now for the ongoing season already, ISMA has cut down the sugar estimate by about 10% from its first advance estimate of about 35 million tons to 32 million tons, and an interaction with many of the sugar mills tell us that the crop next year also could be lower, and this 32 million tons could also be revised further lower. So that is another key positive, that more cane is diverted towards producing ethanol, and that would bring down the sugar production as well. The lastly is the favorable export. So the government has mandated a minimum export quota of about 5 million tons for this season. That in part with the help of export subsidies like transport subsidy and direct cane payments to the farmers. That is a key positive, as well as the fact that sugar prices have run up significantly, almost 25% on the back of a lower sugar production in Brazil. They are estimated to produce 9 million tons of less sugar in this season on account of strong demand for ethanol, as well as heavy rainfall in the key cane growing regions, and that is supposed to help the sugar companies as well.
Okay, Yash, that's a comprehensive detailing of the sugar mat, and thanks so much for bringing us that. So let's wait and watch if there is some more upsides over the course of the next few quarters for the sugar companies. Very difficult to mention whether it will happen in the immediate future or no, but that brings us to the end of First Word. Lots more lined up on Indian Open, though. We discuss markets and macros with Saurabh Mukherjea of Marcellus Investment Managers. He joins in to talk about his thoughts. Then RBI has thrown a safety net for NBFCs by allowing them to seek backing from a higher rated entity like a bank. But will this measure help refinance borrowings and overcome liquidity? And more importantly, are mutual funds willing to roll over some of the commercial papers that are coming up? We speak to two AMCs, Radhika Gupta of Edelweiss AMC and Swarup Mohanty of Mirae Global Asset Investments. All of that's coming up on Indian Open. Stay tuned.
Good news, got a promotion and a damn good raise.
Congrats बेटा।
वाह, रेज अब तो इंश्योरेंस पॉलिसी ले ले।
कौन सी कंपनी से लूं?
चूज वही जिस पर हो पूरा भरोसा।
That's good, but आज की जनरेशन wants everything online. Easy premium payment options, loan facilities और wide range of products.
पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना, same choice. LIC.
LIC trending with times. 62 सालों से हर जनरेशन की पसंद।
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. You know, if you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. Coming. Product of the year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture a billion.
Hello and welcome to Saal Mubarak, our annual show around the Diwali time when we speak to some of the best voices in the markets to try and figure out what could happen over the next 12 months, essentially from this Samvat to the next Samvat. And our very special guest today on Saal Mubarak this time around needs no introduction, Rhythm Desai of Morgan Stanley with me in our studios.
Relative performance and relative valuation, they're somewhere here, not here. So it's the US markets that are demanding, the multiple, not the EM markets. They're not trading at a demanding multiple. So I would think that if the Fed has got it wrong, probably be more wary about the SPX than the MSCI.
And hopefully the new year brings in a lot of cheer for everybody at home.
Yeah, I think it will.
You think it will?
Yeah.
Welcome back. You're watching Indian Open right here on Bloomberg Quint, and I'd like to take a moment to wish all our viewers a very happy Dhanteras before we go across and take a look at what's the Asian market back looking like. So a down day. And nonetheless, it was a good week last week, and we saw that for ourselves as well. But Asia today, taking cues from the US, which saw the first decline in 4 days, is also down. So heavy cuts of about 1% on Nikkei. That's S&P for you. Dow Jones, Nasdaq, that's a US snapshot for you. But nonetheless, for them too, last week was one of the best week in 6 months. For us, it was the best week in 2 years. So 5.5% gains on the index. Mid-cap index rising 7.5%. We couldn't have asked for more. That's the SGX Q this morning, about 0.5% lower. Agam is joining in right now to take us through the F&O picture and how we stack up for trade as we head into this Diwali week. Agam,
good morning, Devi, and happy Dhanteras to you. Well, what we've seen last week was a lot of strength and return of strength in the benchmark indices, given the 5% gains over the last 1 week for the Nifty 50. A bulk of those gains came in last Friday, considering the Nifty index moved up by as much as 1.7%, and there were longs building in to the system. It's the same for the Nifty banking index too, where the index advanced by 1.5%, and we saw open interest rise by around 12%. But moving on, let's talk about some other variables. And in terms of the way we've seen the volatility index come through, or for that matter, several of the other variables, we're starting to see some strength coming in. So the wicks, of course, came off to a certain extent, and we also have a lot of changes with respect to your open interest. So we will have currently your open interest stands at around 10,200 put and the 10,500 call. It is a 500-point range, and that's the kind of range that we're expecting the Nifty to move within, at least in the near term. And of course, the put-call ratio also for the Nifty has risen to around 1.63. But moving on, let's talk about some of these stocks as well. And we have Arvind, which will be in focus, considering we saw so much weakness coming through. Of course, other than that, there were two other stocks which did reasonably well, but there was a lot of accumulation towards longs, possibly, considering SRF, which ended the day with gains of, well, marginally in the green, but open interest increased by 15%. And the other one was IGL, along with several other city gas distribution companies which are buzzing in trade. We saw gains and strength come in. So I will be watching out for some of these names, and perhaps more importantly, the index and what it does as we move into trade today.
All right, Agam, thanks a lot for that. Neeraj, it's also going to be interesting to see what happens to the NBFC space this morning, because, with the announcement of RBI and the partial credit enhancement that they can get from higher rated banks, will definitely augur well from them in terms of at least probably reapproaching market borrowings, which has sort of slumped up till now, because, their credit ratings can get that slight boost of at least 1 to 2 notches. But whether or not it actually, means a total shift away from bank credit, which they had been moving towards now, considering that their market borrowings, the liquidity was a bit tight, whether that will change, dynamics will change there, or they will continue to get their liquidity both from the bank credit lines as well as now get this additional liquidity boost from these rating changes.
Yeah, so. Well, I think it's probably difficult to decipher what shape and form it could take and what benefits will come in. But the good part, Devina, to my mind, is that the last 30 or 45 days, there have been enough and more, maybe not enough and more, let me rephrase myself, a number of boosters, small boosters that have come in as and when needed for the NBFC space.
You spoke to Rishesh, and he did mention that for liquidity purposes, they are at threshold level for most NBFCs. So they are at levels where they can do repayments, but probably growth is something that cannot come in with the levels of, because they're still holding on to a lot of cash.
Yeah, so, and I think it's difficult to let go of that phenomenon, because who knows about what redemptions will happen 3 months down the line. But yeah, small boost for NBFCs, and maybe some of those could react in the session today. So watch out for a lot of result names, and watch out for the NBFCs in particular as well.
Yes, most definitely. We'll be watching out for the likes of ONGC, SAIL, and what all the numbers they've come out with. But other than that, the big boy SBI reports numbers. We'll talk about all of that and more with our research team. Some previews going, some stocks in news, and results and reactions to those results as well. Our entire research team is here with us. Happy Dhanteras to all you guys. I'll start off with you, Darshan, first. SBI, the big boy, coming out with numbers.
Yeah, so for SBI, if you're looking at it, NII growth of close to 15% is what we are anticipating. Profit will be lower by 50% because last year in the same quarter, they had the stake sale of the life insurance business. So there was this one-time gain that came in. Basically, higher interest costs and lower recoveries will dent NII growth for the company this time around. The trend in fee momentum has remained healthy, and that is expected to continue to do well. Loan growth improvement will mainly come in from the retail book. That's what you saw even in Axis and as well as ICICI Bank. But the corporate loan growth book is also expected to be strong for the company this time around. Slippages probably will be lower than what it was in the first quarter because there was no momentum built up in any of the NCLT cases. Credit costs will moderate from the existing levels, and there could be potential MTM losses because of the bond yield hardening for them. So there could be losses that could come in. So that's what's expected from SBI this time.
All right. What about Cipla?
Yeah, for Cipla, if you're looking at it, it will be a muted quarter. 5% top line growth, 7% bottom line growth, and EBITDA growth of just 4%. So it's expected to be stable, given the fact that the bases of both the US business and India business have gone up. US business, no doubt, there will be competition, but the rupee appreciation and some of the key launches that they've done will help the company. So drugs like Dacogen, Pulmicort, all of them were launched by Cipla. They have other recent launches that will help them. US revenues we're expecting to come at over $100 million. Acute season in India will aid the domestic revenues, but remember, even in India, that comes on a base of comes on the back of a higher base this time around. They've done a lot of cost initiatives, cost benefit that will aid the operating margins, and even gross margins are expected to improve, which in turn will flow to the operating margins for the company.
All right, Darshan, thanks a lot for that. So two numbers there, Cipla and SBI to watch out for. Agam, results that came out post-market as the good ones.
Yes, the good ones. But I'm going to start with the one which is mixed earnings, even though prima facie, if you consider it, well, there was a reasonably healthy set of numbers. Sun TV, where you saw revenues rise 11% and net profit rise 23%. Again, because of that, we've also seen margins expand to a certain extent at around 73.9%. Coming down to Equitas, again, very surprising earnings. And do remember, this one has seen a lot of volatility over the previous few weeks. We saw net interest income rise 27%. Net profits has moved on as much as 4.6 times on a year-on-year basis. We also saw advances rise 36%. Moving on to Godfrey Phillips. Now, again, we have seen revenues decline by as much as 2.7%, but its profit rose 20%. Do remember that this was one of those. This was one quarter where we did see a rise in cigarette sales on the whole, considering there were no changes in the taxation structure. And finally, Relaxo Footwear. Again, very healthy earnings coming through, up 18% when it comes to revenues. Net profits rising 23%, and we have seen a little bit of expansion in margins at around 13.5% against 13.4%. So on the whole, these are just some of those stocks that may react on positive cues coming.
And the negatives, Nikki?
I'm going to start off with Tata Chemicals. Weak set of numbers reported by the company. Top line, we're looking at a 10% uptick there. But then if you look at the bottom line performance, that remains flattish to muted on account of the disappointment that has crept in through the EBITDA performance, down by as much as 5.6%. Margins have contracted to 20% as compared to 23%. But then importantly, the company has announced a 2,400 crore capex plan and plans to enter lithium battery sector to develop cell chemistries. Besides that, we're tracking in BSE. Extremely disappointing set of numbers. Revenue down by 3%, EBITDA is down by 70%, and the margins have shrunk to 9% as compared to 29%. Employee costs has led to certain amount of disappointment, though we've also seen some level of muted performance coming in from the top line growth. JK Cement on the other side, that's reported good set of numbers. Revenue seems to be muted, but when compared to the estimates, it's pretty much better than estimates. Net profit is down by 30.5%, again higher than the estimates. EBITDA has come lower, but then on account of better than expected realization, we're looking at that beat. Oracle Financial Services on consolidated basis, sequential numbers don't look that pretty enough. Revenue down by 9.8%. We've seen a downtake coming in on the bottom line performance on account of poor show that we've seen on the operational front. EBITDA is down by 20%, which has led to the margin contraction to 41% as compared to 46%.
All right, Nikki, thanks very much for that. We'll watch out for those names. ONGC, though, expecting a positive open. Comment?
Well, it could be because the numbers were operationally in line, and on the net profit front, it was a big beat on the back of high other income. Now, if you see the headline numbers for ONGC, the revenue was higher by nearly 3%, but the EBITDA rose nearly 7% compared to last quarter. Margins expanded to 56.4%, while the net profit jumped nearly 35% to close to 8,265 crore rupees. Now, on the operational side, the net realization stood at around $73 per barrel, the highest ever reported by the company on the back of no subsidy burden seen in the second quarter of financial year 2019. On the sales side, the crude sales slipped 6%, while the gas sales rose nearly 3%. But due to high realization for the crude numbers, the revenue from crude sales increased marginally to close to 20,600 crore rupees, while revenue from gas sales increased 7% due to higher volumes seen in the second quarter. Now, higher other income, lower finance cost, and lower foreign exchange losses aided ONGC's financials in the second quarter. Other income jumped nearly 4 times to close to 2,394 crore rupees, aided by a dividend income of close to 1,300 crore rupees in the second quarter. Foreign exchange losses were lower by nearly 39% compared to last quarter. Lastly, the finance cost, now that was lower by nearly 16% compared to last quarter because the company was able to reduce its debt by nearly 45% to close to 14,000 crore rupees as of second quarter of financial year 2019.
And GAIL, results come out today?
Well, yes, GAIL is expected to report a strong quarter. Now, if you see the headline numbers for GAIL, the revenue is expected to be higher by nearly 3% to close to 17,800 crore rupees, while the EBITDA is expected to rise by nearly 8%. Margins are expected to expand to 13.6%, while net profit is expected to be higher by nearly 21% to close to 1,500 crore rupees. Now, on the operational side, the gas transmission volumes are expected to be marginally higher to close to 108 million metric standard cubic meter per day, while the petchem volumes are expected to rise nearly 11% to close to 184,000 metric tons. Now, a strong quarter is expected from GAIL on the back of hike in pipeline tariffs, higher contribution coming in from the LPG segment, and because of the LNG imports. Now, the petrochemical segment, that is expected to benefit on the back of higher product prices, higher volumes, and operating leverage that GAIL will see in the second quarter. Now, the gas transmission business will benefit from the hike in pipeline tariffs seen in one of its key pipelines and other key regional pipelines. Now, as this hike had a retrospective effect from 1st April 2018, there would be a one-off which would be related to the tariff hike gains that the company will see in the first quarter, which will be reported in the second quarter. Now, the LPG segment, that will benefit purely in the back of higher LPG prices, while the gas marketing segment could surprise in the second quarter because of the US LNG imports had seen a ramp up towards the end of first quarter. Now, the US LNG imports are expected to boost the trading profits of GAIL because the stronger LNG prices should lead to a trading gains when it comes to the LNG contracts that the GAIL has in the second quarter. Lastly, key things to watch out for from GAIL India earnings would include updates on the progress of the key pipelines that the company has, along with this management commentary on how they are placed when it comes to the US LNG contracts, and updates on the pending pipeline tariff revisions would be key things to watch out for from the GAIL India earnings in the second quarter.
All right, Soumya, thanks very much for that. Well, those are the stocks we'll watch out for, but for the time being, we've got Brijesh Bhatia joining us right now to give us his view on technicals in the market right now. Brijesh, for the Nifty, Friday session and the entire last week was a good up move. Is that likely to continue according to you?
Yeah, hi, good morning, and happy Dhanteras to all the viewers and your team. Okay, starting on the Nifty, we have, after nearly 7 weeks, we have seen good up move and sentiments been changing on the street now. And I think slight dip can be expected with the momentum. This momentum might take a slight pause towards 10,400, 450 zone. And I think from a short term, purely from a trading point of view today, we should look for a sell opportunity at 10,560, 570 levels on the futures. And I think 10,450 is I am expecting to test the level on the downside for a couple of reasons. First, if you look at this rally, it has been completed the reciprocal AB equal to CD, which is the reversal pattern. And if you look at the weekly charts, 10,600 still makes a minor resistance zone where Nifty has halted on Friday's session. So I think slight dip can be expected on cards around 10,450, and I would like to look to short opportunity for a trading point of view only on intraday basis, strictly on intraday basis for the target of 460.
All right.
Okay, Ruchit, come to you. Good morning and happy Dhanteras, and how are you approaching trade today?
Yeah, hi, very good morning, Neeraj. Happy Dhanteras to your team and to all the viewers of Bloomberg Quint.
Well, if we see on the Nifty front, we have recently discussed that as per the Elliott wave analysis, we have seen a completion of a 5-wave decline near the recent lows of 10,000. Now, usually whenever we see an up move after such a completion of 5-wave decline, it retraces about 38.2% or 50% of the previous correction. So we are expecting that this up move which has been seen during last week, this would be extended towards 50% corrective move of entire correction that we have seen in the month of September and October. So that 50% correction is placed around 10,750 to 10,800 kind of levels. Before that, around even 38.2% retracement is around 10,680 to 10,700. So if intraday declines, if any, maybe 40-50 points decline if we get in morning session as the SGX Nifty is indicating, then we believe that that should be used as a buying opportunity. So around 10,500 in Nifty spot, look to buy Nifty futures, keeping stop loss below 10,400, expecting target around 10,700.
Okay, let's also run through some stock ideas. Ruchit, let's go through your list first. You've got a call on Vedanta and you're liking Ashok Leyland as well.
Yeah, so Vedanta, we have seen that around 200 the stock has formed a very strong support base. Not only once, but since the month of March, I think this is the third or fourth time where the stock prices went near the 200 mark and again has shown a bounce back move. Now, if you see the volumes in last two trading sessions along with the up move, the volumes are quite good compared to what we usually see on a daily basis. Also, some of the other indicators such as RSI and stochastics have given a buy indication. So we are expecting this up move which we have seen in Friday's session to continue in next 1 or 2 weeks. So one can go long on Vedanta with stop below 214 for target of 245. Ashok Leyland is a pick purely based on this options unwinding that we have seen. In Friday's trading session, although the stock had traded in a very narrow range, but right from 115 up to 135 call options have witnessed unwinding. So all the call writings that had happened in Ashok Leyland during the start of the series, we have been witnessing unwinding in Friday's session, and 110 put option have added significant open interest. So this is an indication that call writers have been exiting the position and fresh open interest built up have been seen in put options. So I think Ashok Leyland would see a decent short covering since we have seen a good short amount of short positions during last series which had been rolled over too. So one can go long on 120 call option based on this analysis which is trading around 5 rupees now. Keep a stop below 2.5 and expect target around 9 to 10 in this series.
Okay. Brijesh, your ideas as well. You got a call on Ashok Leyland as well. So a very strong bias there. And Gujarat Fluorochem.
Yeah. See, already Ruchit has discussed the derivative structure on Ashok Leyland. So I would like to add on the technical front. If you look at the stock, majorly auto space were under pressure, and if you look at the Ashok Leyland, still Ashok Tata Motors and Maruti were making new lows, and this stock was slightly consolidating for last 20 days. And on Friday session, we have seen that range breaking out at around 115, and already we have seen unwindings, short unwindings coming on in the stock. And if you look at the momentum indicators, all are trending very, very positive, and RSI again marking above 50 zone is a sign of bullish trend continuing. So I think with these breakout, stock can test 200 days in this momentum, 200 days average, which is around 126. So I would like slightly keep a target of 125 and stop loss of around 130 is just slightly below the range. Second stock is Gujarat Fluoro. If you look at the momentum, stock is gaining strong momentum, and if you look at the volumes are very much picking up in this recent consolidation, and we have seen breaking out of the bullish head and shoulder pattern. So I think at around 885, one can keep a stop loss of 855 and look for an opportunity for 10% upside towards target of around 979. So this will be slightly couple of 2 to 3 days trade. I would look on Gujarat Fluoro, and one can expect a target of 979 on the upside.
All right, so strategies that are coming in from Brijesh as well as Ruchit. Just stay on with us, gentlemen. On to a special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a stock or a particular trend that he spotted. Yash, what's the stock on your radar today?
Good morning, Devina. The stock today is Future Lifestyle Fashion, and there the bullish engulfing pattern has been formed on the charts. Let's first try and understand what the bullish engulfing pattern is. It is basically the formation of a bullish candle right after a bearish candle, wherein the body of the second candle completely engulfs the one in front of it, which is the bearish candle. The longer the second bullish candle is, the greater are the odds of a rally. No further confirmation needed. Let's get the chart back up. As you could see with the move on Friday, the big green candle that you're looking over here, that has completely engulfed the bearish candle in front of it. Now 360 odd levels, that is where a near-term bottom has been formed for the stock, wherein it has tested these levels but has managed to bounce from it. With this formation, it indicates that there could be further upside to the stock from the current levels.
Okay. And how has this worked in the past, Yash?
Well, every time the indicator turned positive and you had gone long in the counter, it would have given you a positive return of as much as 7% in the last 1 year.
Wow, that's not bad. Okay, so 7% in the last 1 year, that's to be monitored. So Future Lifestyle is a stock in focus today as per the Bloomberg terminal. Thanks a lot for that, Yash. Let's talk about some fundamental pieces of news. Remember, now viewers, for all of you who are tuning in right now, up until now, we've discussed a lot of important stocks already. So Axis Bank, the numbers were very strong, and the stock is likely to start off positively today. We'll discuss that with Saurabh. Mukherjea will be joining us a bit later on in the show to talk about that. So one was Axis Bank. The second is SAIL. Very strong quarter, but the numbers slightly below estimates. So difficult to quite predict as to what the stock could do in today's session. But the stage is set for the stock to do reasonably well if the business does as analysts expect it to do. So that's the second most important stock for the day. And to my mind, what is also very, very important is the stock of BSC, and we'll talk about that as well. The numbers very, very disappointing. But the stock has corrected quite a bit in the last 6 odd months, so maybe that gives a bit of a cushion. Maybe there's a valuation cushion out here for Bombay Stock Exchange as a stock too. So 2 or 3 important ones to monitor in the session today in the listed space. Now, there is one company that gets listed today of sorts, Adani Gas, the gas sourcing and distribution business that was spun off from Adani Enterprises earlier this year, will be listed on the exchanges today. For all of you who might be getting the shares, and for all of you who don't get the shares but might be interested in knowing whether it's worth buying or no, Sumit Sarkar is standing by with what could the indicative listing price be and how does it stack up against its peers. Sumit, good morning yet again.
Good morning again, Neeraj. So if you see, the company will be listing today after getting demerged nearly 2 months back. Now the shares will trade in a trade basis for Adani Gas. So there for the next 10 trading session, which means there cannot be any intraday position that we can take for the stock. Now when Adani Gas gets demerged from Adani Enterprises, the post demerger pre-open price for Adani Enterprise was close to 150 rupees per share, which means that Adani Gas could list at around 60 rupees per share. So let's see how the valuations would stack up at the indicative price of 60 rupees per share. Now, at 60 rupees per share, Adani Gas market value would be close to 6,600 crore rupees, and its valuations, that is price to earnings and EV to EBITDA, would be expensive when compared to its peers like IGL, NGL and Gujarat Gas. Now for FY19, the company's price to earnings would be close to 30.6 times, while EV to EBITDA would be close to 16.8 times. Now given the growth prospects that Adani Gas has, these premium valuations could sustain for the company, but we'll have to see how that pans out for Adani Gas. Now if you see, Adani Gas is the city gas distribution unit of Adani Enterprises. Currently it has operations only in 4 areas, 2 in Gujarat, 1 each in Haryana and Uttar Pradesh. So if you see, it's a very small operation so far. But here's the interesting thing, the company has more than 30 non-operational areas, and the kind of growth that the company is expecting is very large. Now if you see, the company currently does a volume of close to 1.4 million metric standard cubic meter per day. Now because of this, more than 30 non-operational areas, this volumes could rise 8 times to close to 10.5 million metric standard cubic meter per day by FY25. Its total CNG gas stations could increase from 65 to 1,030, and the total PNG customers could increase from 0.35 million to close to 6 million by financial year 25 on the back of this more than 30 non-operational areas. So this is the kind of visible growth that Adani Gas has over the next 3 to 5 years. Now Let's see how the companies stack up again financially when compared to its peers. Now, if you see over FY14 to FY18, Adani Gas revenue saw a degrowth of nearly 4%, but that was because of slow expansion. But if you see the EBITDA, the company has seen a good growth of around 21% over FY18 to FY18, which is the highest when compared to its peers like IGL, MGL and Gujarat Gas. On the net profit front, over FY14 to FY18, the company's net profit grew at a CAGR of 38%, against the again higher rate when compared to IGL and MGL. Now, Gujarat Gas net profit grew at a 79% rate, but that was because of a lower base in financial year 2014. Now, on the operational side, if you see, the volumes were a bit subdued for Adani Gas because of the slow expansion, but its unit metrics, that is the EBITDA per standard cubic meter or the profit metric for Adani Gas, now that grew at a CAGR of 16.5%, again highest when compared to its peers like IGL, MGL and Gujarat Gas. And also, Adani Gas is one of the most profitable city gas distribution company when compared to these three peers. Now, if you see on the balance sheet side, the company has a debt of close to 311 crore rupees, but that must not be a concern for the company because its leverage ratio is well below 1 times. Its total debt to EBITDA is only 0.8 times. But given the kind of expansion plan that the company needs to do for this non-operational areas and also for its existing areas, the debt number could rise for the company, or else it could also do a fund infusion via equity. So that is one thing that investors need to keep an eye out for when it comes to Adani Gas.
All right, we'll definitely keep an eye out on today's listing. Soumya, thanks very much for that. So we're just under a minute or so away from market pre-open, and the ticks and the indication in the morning is that we're going to be probably looking at a negative start to the week. Asia as a pack seems to be weak. Nikkei is down about 1% plus. We've got Shanghai down in the red by closer to 1% as well. SGX Nifty for itself, indicators of about 0.5% cut coming in there. So where the big bang start to the week may not happen, but we've got the rest of the week to see how we shape up and whether or not we see an encore of last week's performance for the benchmarks as well as the mid caps. But those pre-open ticks should come up on your screens any moment from now. That's SGX for you, 10,532 is where it's trading at.
We should have a start which is slightly weak, but the question mark only is, can some of the results prop us up high?
Well, that's the start for you. The Nifty as well as the Sensex initial ticks positive, almost 1% higher for the Nifty. The Sensex showing an uptick of 1.5% though. 10,600, that's the mark on the Nifty. We'll wait for consolidation of these prices, but just to quickly run you through, we spoke a lot about Axis Bank and the numbers, and that's showing you an initial uptick of 10%, may not hold as we settle down prices during pre-open. ONGC is up about 10% also. Great quarter for them on the back of rise in crude prices as well as the depreciating currency. It's now cooled off to about 5% higher. But remember, ONGC is nonetheless a heavy weight on the index, so may help prop up the Nifty to a certain extent. M&M 1.9% higher. Titan is up about 1.6%. Z is up 1.1%. Tata Steel, IndusInd Bank, Vedanta, Tata Motors moves up 192. So not bad going for Tata Motors actually after seeing that consolidation closer to about 170, 172. Stocks finally started moving up, and you saw that last week as well. Amongst some losers then, Indian Oil, that's IOC, is down 1.5%. Wipro is down 1%. HDFC Twins are down 1% apiece. Adani Ports, Power Grid and HUL are some of the other bigger losers in trade.
Well, let's look at the mid-cap end of the market. A couple of, by the way, the currency and the bond yield should come up on your screen once if Devin has not marked it already. 72.79. That's a reasonably sharp downtake after 2 or 3 days of a big pullback that we've seen in the currency already. A bit of a sharp pullback downwards, 72.80 or thereabouts. The bond yield should come up on your screen at about 7.78. Those are okay, not a dramatic change thereof. Surprise, surprise, 8K miles is showing an uptick, but anyways, these numbers could change any moment, so let's give them a chance to stabilize. I was interested in seeing what Bombay Stock Exchange or BSE as a stock is doing post the numbers that came out. Unchanged for now. SAIL, very strong quarter, but sub-estimates, that's the key, and let's see how SAIL is reacting. For now, about 1% and a quarter, but let's see if these change. There is strength in Prestige Estates seemingly. Let's wait and watch if that lasts or no. But otherwise, it doesn't seem to be very heavy in terms of a trade. The Motilal Oswal stock has some unnatural downtick. I think that will change as well. Kaplan Point about a downtake of 9%. Let's wait and watch. And SH Kelkar about a couple of percentage points. Those are 2 or 3 names that look like standing out. But anyways, all of these rates will change in a few minutes. So let's give them a chance to stabilize. For now, we look like we'll start off marginally lower, but we'll know about it in about 6 odd minutes. But time now to get in a very special guest, somebody who I'm sure all of us love listening to, Saurabh Mukherjea of Marcellus Investment Managers with us on the show. Saurabh, so good having you. Thanks so much for joining in, and happy Dhanteras to you.
Same to you.
And your new team as well.
Thank you very much. Very kind.
Yeah, it'll be a bit of a different Diwali for you as well. For years for the last few years in the sell side and now on the buy side. How is the stage set, Saurabh? We'll talk about the here and now as well. Sure. But just broadly, how is the set stage from this Diwali until the next Diwali?
I think we'll have an interesting 12 months. Obviously, there's the election to look forward to. But beyond that, we'll have a sort of a balance to play in India between what will be a credit crunch. I think the credit crunch will be extended in our country, whilst I'm sure the RBI and the Finance Ministry will do their best to make sure that the NBFC sector holds up. It does look as if money will be pretty tight in India over the next 12 months. But that being said, the positive momentum will come from, I think, a capex recovery on the other side of the election. Capacity utilization seems to be trending up in many sectors. So India will be, I think, a dance between, on the one side, money will get dearer, credit availability will be tougher, but on the other side, we do seem to be overdue a cyclical capex recovery, which I suspect will come on the other side of the election.
Interesting. Speaking of NBFCs, and we'll talk about the long term in moments from now, but the short term, at every single point of time when there's a hue and cry about there being a dearth of liquidity, there comes to a measure or two that the RBI throws in, the Finance throws in. Something happened on Friday as well.
Sure.
Are the near term concerns getting a bit alleviated?
I think there's 2 layers that one needs to think about this problem. One is obviously the famous figure of 1 trillion rupees of CPs which are due between now and, say, Christmas Day. And clearly, as we are all reading in the papers, there are frenetic efforts underway, both on the parts of the NBFCs and on the part of the RBI and the Finance Ministry, to make sure that by and large, most NBFCs have adequate funding. And I think the industry and the regulators will be successful in that count. Where I think the challenge is a bit deeper is there's a few NBFCs, or more specifically a few housing finance companies, where I think the asset liability mismatch is so profound that it'll be difficult to sort of help them out over a say a 6 to 12 month period of time. So whilst for the industry as a whole, there will be money made available. These are fundamentally viable entities by and large. I think there are a couple of pockets in this sector, specifically on the housing finance and real estate developer funding side, where I think the concerns are so severe that you will have a challenge over the next 12 months. Now, whether that happens this quarter, next quarter, is anybody's guess, but there are some fundamental problems in the housing finance sector in our country.
You know, I just want to have a takeaway from you as well on what Mr. Rashesh Shah spoke with Dheeraj in his conversation. He said that the problem is not with having liquidity, because most NBFCs are sitting on a lot of cash right now because they don't want to deploy. So the question is not repayment, the question is future growth for these NBFCs.
So yes and no. I think where the word liquidity is being used by and large by most people as a euphemism, right? Yeah. So it's not as if banks don't have money, banks have money. It's not as if banks don't want to lend to all NBFCs, but everybody in this sort of system knows that there are a few HFCs out there whose books really are pretty questionable, the quality of whose credit is fairly questionable, and unfortunately, the size of these HFCs is big, and which is why the ILFS analogy is repeatedly evoked. So yes, Rashesh Shah is obviously right. At one level, most NBFCs have got perfectly viable businesses, which both the mutual fund industry and the banks are happy to support. But there are a couple of pretty deep trouble spots in the sector, and the challenge.
Which may not lead to contagion, right? It could be a specific.
It's the world over, Devina. This challenge with this construct is the world over. If you have 3 big boys who blow up, right, it's very difficult for the system to finance the rest, oblivious to the blow up elsewhere. We've already had one blow up, and you know there are a couple of other clear spots of trouble in the sector, especially around real estate developer funding, and hence there's a degree of reticence on the part of the financiers, whether they be banks or mutual funds, to have too much exposure to the sector. So the net result will be, as you were alluding to, the net result will be that most NBFCs, 80-90% will pull through, but with growth disappearing. So they will hold their loan books together, they'll hold their credit quality broadly together, but growth will disappear. The sector will become an ex-growth sector for, I suspect, 12, perhaps 24 months, and hence valuations will derate. But by and large, the bulk of the sector is well run, and I think will pull through.
Interesting. A few questions for the here and now. We're just about 7-8 minutes away from pre-open session. Saurabh, I would have asked you maybe 12 months earlier about what's the note that you've written on Axis after the numbers that have come out, but just an opinion of what you thought the numbers were and what the outlook could be for a bank like Axis?
So clearly, I mean, the heavy pounding that their loan book took in the last 8 quarters has dealt with the crux of the problem. And the bank seems to be in much better shape than it was 2 years ago. That being said, I'd wait for the new CEO to come in, settle down, get his top team in order, get his strategy rolled out before I build exposure to the bank. As I said, I don't think the corporate capex cycle is going to bring in tomorrow morning. I think we've got 3 quarters to go before we see any meaningful uptick in corporate capex. And given Axis's credentials as primarily a high-quality corporate lender, I think we've got time before we start loading up on Axis. So I'd wait for the new CEO to come, get his top team together. My reckoning is there will be some churn in the senior management in Axis, and then I want the new CEO to get his first results out of the way, and then I would look at consider building exposure in Axis. I think it's a little premature to load up on Axis.
But the numbers for a lot of these corporate-facing banks are, I mean, save yes, and numbers for a lot of others are starting to look reasonably okay.
But they are. You're right. But where we got to be careful is, remember, the banking sector has around 5%, basis the RBI data, 5% of the banking sector's loan book is exposed to the NBFC sector, and over and above that, the banks have some direct exposure to real estate developers. So whilst we just had the NBFC discussion a few minutes ago, the banks do have some exposure to the most troubled players in that NBFC sector, and they obviously have exposure to real estate both through their mortgage financing books, and they have some real estate developer funding. So in a world where cost of capital is rising in America, we had some spectacular US payroll numbers. There will be further hikes from the Fed. There will be hikes in the cost of funding in our country. Where the cost of funding is rising globally, it is difficult to say let's run out there and load up on banks. I would be very careful about loading up exposure to BFSI over the next 12 months. If you look back at Indian history, every single time the cost of funding rises in America, within 7 months, the bank X pulls back by 35%. It's almost like an iron rule of finance. 2006, 2008, 2013. Whenever America says cost of funding is going to go up in our country, within 7 months, the bank X pulls back by 35%. We haven't yet had a 35% pullback in bank X, so I would hold my horses on further exposure to BFSI.
So far, it's been the tech stocks that are causing that stir in US. So we'll have to wait and watch if this has any meaningful impact. But just hold on, I'll just go click across to our technical experts as well. A quick take on Axis Bank before we go on to all you need to know. Ruchit, a quick take on Axis Bank since we were on the topic.
So the trend, at least the short-term trend, seems to be positive because the stock has again given a bounce back from its 200-day moving average support. So on the higher side, we can expect levels around 640 to 650 is one is looking from a near-term perspective.
All right, that's Axis Bank. And with just 4 minutes left to go for market opening. So let's quickly tell you all you need to know to stay ahead in trade this morning. First up, let's take a look at the Nifty earnings. GAIL, Cipla, Power Grid and SBI are expected to report their results today.
Amongst the companies that reported their numbers on Friday and over the weekend, Axis Bank, Sun TV, Equitas Holdings, Godfrey Phillips and Relaxo Footwear posted a strong set of numbers.
However, Tata Chemicals, BSE SAIL, Oracle Financial Services Software, JSW Energy, JK Cement and VRL Logistics missed street expectations.
That's not all. There were a few that just about crossed the line. Nifty Biggie ONGC, Torrent Pharma, Cadila Healthcare, and Gabriel India reported an inline set of numbers for the September quarter.
And moving on, here's an update from the pharma space. Laurus Labs and Strides Pharma Sciences announced completion of US FDA inspections, while Laurus Labs received one observation for its Andhra Pradesh facility. Strides Pharma Sciences received none.
And lastly, KC International has signed a sales and purchase agreement with Adani Transmission for sale of the entire stake in subsidiary worth for about 227 crore rupees. The stock starting off marginally higher in trade.
All right, about 2.5 minutes left to go for market opening. Let's quickly, before we go and take the top calls, sort of just continuing the discussion here of, we have SBI reporting numbers today as well. So how closely are you watching that?
So look, I have to concede that whilst I'm looking at the SBI numbers to get a sense of where we are in the NPA cycle, I've never quite believed that investing in public sector banks will help me make money. Obviously, as we know, public sector banks have other prerogatives other than making shareholders money. They are owned primarily by the government of India, and that's the primary master that they serve. So obviously, by all means, let's look at the SBI numbers to gauge how far we are advanced in the NPA cycle. But as a stock to invest in, I would sort of look elsewhere.
All right, not SBI. Let's get in our top stock calls then from our technical experts as well. We're just under 2 minutes left to go for market opening. Pre-open ticks have cooled off. Nifty is absolutely flat. I'll start off with you, Brijesh. What is the one stock that you're going to be watching out for as we hit market opening this morning?
I would go long on Ashok Leyland if you look for a short-term biased, and that would be the best bet. I think if today also short coverings continue and the volumes increases, I think the stock can see 120, 121 on the upside on intraday basis, and overall I think 125 is on the cards.
All right, and you, Ruchit?
I would recommend buying Tata Motors from an intraday perspective, although this is not the stock that I've often recommended on the buy side. But what we have seen in last couple of trading sessions, a lot of short covering was seen, and the stock has too much short positions. If we see series on series rollovers, so once further short covering can be seen in next 1 or 2 trading sessions. From an intraday perspective, one can go long with stock below 184, expecting target somewhere around 202.
All right. ONGC is the other one. That is crucial because it's already showing you a sharper move on the upside in pre-open. So quick take from you, Brijesh, on ONGC.
I would look for 172 on the upside on ONGC. I think this momentum might continue towards those levels because it has been quietly resisting around 200 days average, and we have seen 2-3% standard deviation of 200 days average when stocks get its momentum hold. So I think 172 or 173 can be expected on the upside at 200 days average test.
Well, let's wait and watch what happens there. Jaman, Ruchit, as well as Brijesh, thanks so much for joining in today and giving us your perspectives. Really appreciate your time and happy that there is 2 on your teams. The important thing will be Axis Bank and whether, because it's not showing the kind of uptick that the GDR showed, and therefore the question remains that whether it will give a chance to buy in post-open as well or no. But here's how we're starting off, very, very flat on this Monday morning. Hardly any movement there. In fact, if anything, the Nifty just starts slipping a little bit. So about 1/4% now, more in line with what the SGX was indicating, about 1/3%. So pretty much in line with the SGX Nifty indications. The mid caps and the small caps should come up on your screen as well. Reckon they'll start off weak. At least the mid caps are. The small cap index for now about 1/3% higher. Let's wait and watch what happens. Get the heat map up on the screen and let's see what's moving and what's not. Axis Bank and ONGC probably perched at the upper end. Axis Bank 2.2%. ONGC hardly anything, by the way. Cooled off completely. Tech Mahindra about 1%, but hardly any gainers. That's the key point. It's a tick of red and a sea of red of sorts on the Nifty. Not too many big losers, but a lot of names succumbing to some selling. IOC about 2.5%, and OMCs, all the 3 results are out and all the 3 counters are starting off weak. Aside of that, don't have too many movers. NTPC about 1.5% lower. IndusInd Bank another 1.5% gone. ICICI Bank about 1% lower. Surprise, surprise, the only one which is making some meaningful move today is Axis Bank, and that too is just about a couple of percentage points higher. So no big gains for any of the key index stocks, hardly any losses as well, just about 2.5%. But the mood certainly not as gung-ho as we had last week, about 1/3%, but the advanced decline very, very skewed. Devina, what are you spotting?
Well, Indiabulls real estate for one, that's right at the top of the heap, 5% higher, and probably get in Saurabh to talk a little bit more on this in a while. But a few numbers, then I'm going to take you through Sun TV. Revenues were up 10%. We'll see how that stock has opened up in trade this morning, down about 2.8%. Torrent Pharma, Kedla Healthcare, Q2 numbers, both these pharma names are reported. Torrent Pharma up about 0.5%, Kedla Healthcare down 2.6%. We've got Tata Chemicals, Equitas Holding is the other one. Net interest income was up 27%, while net profits was 4.6 times. Equitas is up 2% in trade this morning. And a Bombay Stock Exchange that we were referring to in pre-open, just to see how it stacks up this morning, down about 1.5% right now. Aside from that, you've got a Strides to Shoon, which is down up about 2%. Emphasis is up 1.4% at 964. Divan Housing is up closer to 1%. Natco Pharma, Suzlon Energy, you've got Torrent Pharma, we spoke about that, and the others like Gujarat Pipavav have also moved up about 1% or so. Amongst the losers, Sun TV is down 3.5%, Tata Chemicals is down 3%, SAIL is down 2%, Dish TV, Reliance Power, Reliance Infra, these are some of the other losers, and even Jubilant Foodworks dips about 1.5%.
Okay, so net, the start is slightly wobbly, but no alarm bells as yet. The Nifty Bank about 0.5% lower in trade. And on cue, Axis Bank is not reacting too much. In fact, just about now trading around the lowest point of the day. ONGC, the principal gainer. Technology companies making a bit of a comeback. We're in conversation with Saurabh Mukherjea of Marcellus Investment Managers. Saurabh, technology, what's your stance here now? They've had a very volatile period the last 6 months at least. The valuations are a lot more reasonable than what they were, but enticing enough?
So a year ago, around November, December last year, I started sort of shouting from the rooftop that IT stocks were a raging buy. I still think there's value in the sector. So as we're seeing in the Q2 results, these guys are short-staffed in America. But my reading is they will fix their staffing problems, and my reading is the rupee will continue to be weak over the next 3-4 quarters. So IT in our country, whether we like it or not, and actually pharma in a similar way, is dependent on the currency to give them a competitive advantage. For a good 4 years, that competitive advantage disappeared. 3 quarters ago, their problems started getting alleviated with the rupee sinking. I think the rupee has further weakness to go, and I think the IT companies have 3 or 4 wonderful quarters ahead of them in terms of results and in terms of volume growth. So I would still be a fan of Indian IT. I would buy at least one large cap and one mid cap IT stock in my portfolio.
Actually, that's the question, right? Mid cap IT, sort of, the valuations are nowhere cheap. They would be at the upper end of valuation parameters. The last 4-5 years, at least, if not more. Would you be comfortable paying about 18-20 times? So the way to think about it is, if you have a decent IT company which can show around like for like, constant currency growth in the top line of around 9-10%, and with some efficiency gains, show 15-16% EPS growth. Given that this is an immensely cash generative sector, high teens PE multiples is not so demanding for a mid-cap IT firm. The challenge for mid-cap IT firms in our country tends to be that they're very vulnerable to economic downturns in the client geography. Now, if the US economy were to sink into a recession, or if US economic growth were to sink over the next couple of years, yes, mid-cap IT firms would have a problem. For now, the US economy is red hot, the Indian currency is weak, and say a well-run mid-cap IT firm such as L&T Infotech, I wouldn't have too much trouble considering buying it. So yes, there are macro variables. One is our own currency, the second is the US economy. Both of those variables seem to be pointing in the right direction, and a well-run mid-cap IT firm such as L&T Infotech, I wouldn't have too much trouble with the valuations.
I'm going to shift focus to real estate, since we mentioned it when we were talking about NBFCs. And numbers for a few of them have not been bad, the likes of an Oberoi Realty for one. This space, is it still untouchable for you? And the likes of an Indiabulls Housing Real Estate and the others in the same?
So look, I think it's reasonably clear that a combination of GST, RERA, the whole attack on black money will lead to a consolidation of Indian real estate. If you look at GDP data, this is a massive sector. This is almost 10% of the Indian economy. But it's a fragmented sector, and as the sector consolidates, I think we'll end up with around 5 to 10 mega real estate developers across the country, right? So it does make sense to say early on, let's look at the sector, let's look for well-run, well-managed real estate developers with strong balance sheets, the ability to raise money from the capital markets, and if we can find them, let's get in at sensible valuations. So I think there is a argument for buying top-notch real estate developers, and there are top-notch real estate developers out there. The reason I would hold off for a bit is the sector has been shored up by funding from the NBFCs and HFCs. Real estate developers specifically have been shored up by funding from HFCs and NBFCs. I think that funding pipeline is beginning to dry up, and hence I would give it 3-6 months of the credit crunch. I would wait for the consolidation in the real estate sector to begin before I get a couple of good developers in my portfolio. So strong arguments in the long run to buy a couple of top-class developers in a sector which is big, will consolidate, but I would wait before I buy. Wait for the cost of funding to rise further. Wait for consolidation to kick in the real estate developer sector.
Sure, but isn't it like a cycle? Obviously, one of the funding needs to feed construction activities for most of these developers, but probably focusing on developers right now who are sitting on already built inventory which can be cleared.
Right. So remember, whatever inventory you have, the price variable is beyond your control. And I think the price variable, residential real estate, the price variable is going to go south in the next 6 months. As cost of funding rises, say the typical home loan a year ago would have been, say, 8%. We're probably pushing north of 9% of the typical home loan, and my reckoning is we'll probably push towards 10% on the typical home loan a year hence. So as cost of funding for home loans itself rises, I think there'll be further pressure on residential real estate prices. So whatever your inventory is, your ability to offload that at good prices will be in check over the next 12 months.
Well, that's interesting. They sound kind of similar right now, what's happening to real estate and maybe NBFCs, in that the sector has a lot of headwinds. There might be a few companies that will emerge well, and what to do with those. But interesting thoughts out there. The other pocket, Saurabh, and that's not just necessarily from the near term, but from the medium term, is all marketing companies. Now, beaten down, the numbers may vary depending on crude prices, but is that 1 rupee penalty of sorts that was levied kill the sector in the near term?
So I think where the government deserves credit is that they let the price of oil float for such an extended period of time. I thought it was just remarkable show of political guts to let the price of oil float to the point where I think I was paying around 4,000 rupees for a full tank of petrol on my car. Yes. Every time I used to pay, I think, my God, what is happening? This is just unprecedented in our country. That being said, the last month of events around the OMCs has suggested that this government is human, and with assembly elections this month and then the general elections around the corner, they will have to focus on the politics rather than the share prices of the OMCs. So if you buy OMCs today, you're implicitly making a call on who will win the election. And I don't yet have that visibility to make that call. But if this government comes back, if this government wins the election and comes back, then OMCs, to my mind, are a big buy, because the political courage that the government showed in letting the price of oil float, the petrol pump price of oil float till 3 months ago was enormous. And my reckoning is if this government comes back, OMCs become a big buy. But I don't have that visibility on the election result just yet. Hence, I would hold back on buying OMCs at the current juncture.
I just want to comment, since you're on the topic of elections, how closely are you watching the US midterms? Because, the last 2 times in the Obama administration, post-midterm elections, you actually saw a significant up move. But the expectation this time is focus is going to be on government spending and growth of economy, which may not tilt too well for stock markets, and it actually may not lead to a significant upside to the stock markets. Could that have a negative impact for us?
I think the main reason the US midterms are of interest is it'll give us a sense as to whether Trump comes back in another 3 years' time. Because he clearly is changing the economic paradigm in which all of us function. We've seen the effect on the Indian IT sector. The trade war is playing out basically through Trump's whims and fancies. So as a leading indicator of Trump's political future, these elections are of interest. Beyond that, I'm not so sure. I'm not so sure there's that much of an impact on the Indian stock market. I think US earnings growth, which seems to be under pressure.
No, just that the US stock market itself may start to...
My reckoning is the US stock market will tilt with their own earnings trajectory, given how, it's almost like a 10-year bull market, right? 9.5-year bull market in the S&P 500. I think that market, like ours, is now dependent on earnings growth to fire through. Clearly, there have been some wobbles on the big tech stocks earnings growth in this quarter. So I'm not so sure it's the stock market per se, the US stock market that I'm obsessed about. It's Trump's own political future. And if he has a rousing sort of midterm elections, it would suggest that his brand of politics is here to stay, and all of us then have to adjust our expectations accordingly.
Okay, just one final question from mine, and again, elections related, and which is purely a market call, Saurabh. I'm not asking you to take a call on what the political mandate would be, but if the BJP were to lose 2 out of the 3 main state elections, do you think the markets would view that negatively in the near term? Just a market reaction. I'm not saying whether it is positive or negative for the markets or the economy, but how do you think the markets will view that?
Yeah. So clearly, as is well understood in certainly in Mumbai and in the institutional investor community, there is a degree of investor belief in the current dispensation. And if the current dispensation's political future were to look wobbly, there would be downside in the market. That being said, if you ask me from a personal perspective, from a fundamental perspective, I'm not so sure there is that much of a dependence between who's in charge in Delhi, what our economic growth is, what our stock market earnings are. So if the Nifty approaches 9,500 on, say, whether it's on the back of economic catalysts, the NBFC challenges, or the political scenario, if the Nifty approaches 9,500, I've got clear plans set aside for buying pretty aggressively. Already some of the small cap stocks were looking very tasty. A couple of weeks ago, I bought a bit when the market had conked off. I've restrained myself again because people are getting a little excited again. But if Nifty hits 9,500, I think it'll start looking very interesting. At that juncture, you really don't worry too much about the politics of the oil price and so on. Yes, there is stock market dependence on the elections, but one needs to look through that and think fundamentally.
Okay, so buy when others are
so buy when the Nifty hits 9,500. I know we are at 10,500 odd today, but if for whatever reason we punch through 9,500, I think one should start thinking of loading up on Indian stocks.
Just to follow up on that, you said you'll be looking at a level of 9,500 on the Nifty to start loading up on stocks. When we had gone towards levels of 10,200, 10,300, at that time, because of the stocks and the number of stocks on the Nifty index itself, it was amongst the first 5 or 6 stocks that saw that big correction coming in because of the Yes Bank and India Bulls Housing Finance, all these names which triggered the sell-off, and the true value of the Nifty was considered 9,800 at that time, even though it was trading at 10,200 because of these stocks heavily being cut. So in light of that, do you wait for the overall broader market correction also? Because that's something... So
I see what you're getting at. So the way I do it is I identify, say, between 15 to 20 really high-class companies, for super fundamentals, well-run companies. Then I look at their current share prices and I figure out a margin of safety, which is typically around 30-40% below the current share price, right? And I tell my broker that if it punches through that lower bound that I have in mind, I tell him that you don't even have to call me, just buy them if it punches through the lower bound. So that's that lower bound started getting clipped through when the Nifty was at 10,200, right? Yeah. Once again, share prices have risen a bit, but those numbers, to my mind, my buying prices, I don't drive them so much of what's happening in the market. My buying prices are distinct from what's happening in the market, and hence 9,500. At 9,500, I know on a whole bunch of stocks, I will get the prices I want. So my brokers already have the instructions that if those prices come, please load up, don't even bother calling me, because you also want to take emotion out of this whole process. On the day the Nifty hits 9,500, maybe I'll be so terrified I won't be able to put the buy order on. So I get the emotion out of the way by telling him, buy on that day without bothering to call me.
I'm glad you asked this question because this is serious investment advice. Saurabh, thanks so much for giving us that. And to you and your team, a new team at that, a very happy Dhanteras and a great new year.
Now, happy Diwali to you and your viewers as well. Thanks, Neeraj.
Thanks, Saurabh. Pleasure having you. All right, that's a very interesting conversation that we've had already with Saurabh Mukherjea. Must mark the markets a little bit before we move on. About 1/3% lower for the Nifty 50, about 0.4% lower for the Nifty Bank. OMCs are the ones which are the bit of a drag. So IOC, BPCL, HPCL are the top three losers. NTPC down about 3% as well. And IndusInd Bank and ICICI Bank, I must say, on a day when Axis Bank is doing half-heartedly okay, the other private sector banks have come off in trade. SBI out of the numbers up about 1.25%, so not a bad one to have for SBI ahead of the results. Technology is kind of trying to hold the markets higher in trade. Just a couple of names that I do want to mention before we make you hear a small slice of the next important conversation. UCO Bank is up about 12.5%. PC Jewelers, another 9%. Please be careful about trading this one. And Sun TV is reacting negatively to its numbers, down about 4.5% in trade. Well, 3 days to somewhat 2075 as equity traders brace up for more trading. We kick off our special discussions with some of the biggest market voices in the country. Today's guest is the MD of Morgan Stanley in India, Ridham Desai, who believes any change in the Fed's rate hike trajectory will hurt Wall Street more than emerging markets. I spoke to him on our special series, Saal Mubarak, in the lead up to Diwali. Listen in. Hopefully the new year brings in a lot of cheer for everybody around.
Yeah, I think it will.
You think it will?
Yeah.
The factors are set for that? I'm just talking about the market.
Factors are not set. Prices are set.
Prices are set. Okay, explain.
Yeah, I mean, there's been so much damage to prices, right? In the stock markets, you make money only when you buy cheap. Otherwise, you don't make money. So it doesn't matter what the factors around it are. And there's always uncertainty. Sometimes good, sometimes bad. You play at the right price, you make money. And I think, well, it's hard to say whether the price is right, but it looks better than it has been for the past say, 18 months or so. And especially last quarter, last year, when mid caps and small caps were on a tear and ended the year up 60%. Quite clearly this year, at the start of the year, we were quite cautious on mid caps because we didn't feel that the price was right. Now, all that has adjusted. So, yeah, there are a few issues with the macro, and frankly, it's very hard to predict what shape and form they take. But given a little bit of time, things will settle down, things will get better, and if you bought stocks at the right price, you eventually make money.
Interesting. So, okay, I just thought I'll start off the interaction with three things. The Fed, trade wars on the global front, and elections back home in our own backyard. Yeah. Now, one binary event of sorts, and two not necessarily so. So there is uncertainty for sure, at least in the first 6 months, if not the whole year. Even the valuations are right. Can the valuations become even better if any of these three don't play as per plan?
Yeah, they can. So let's put it into context. The market is right now at 2.8 times book. Most people quote multiples on price to earnings, but that assumes that earnings are at trend level. Okay. When earnings are off trend, as they are right now, and they're way below trend, we've been in an earnings recession which has lasted longer than I ever thought. And I've been continuously telling you that earnings are going to turn, and they're still not turning, at least not on a headline basis. So very clearly, we've not been able to call the earnings cycle right. Price to earnings becomes less useful in trying to judge where valuations are. Price to book is at 2.8. How does that compare? So the average for the market going back 25 years is about 3.1, 3.2. So it's kind of below average. There have been 4 occasions the market has traded at 2.2 times book in the last 25 years. So you got that opportunity in 2003, you got it in 2008. We didn't quite get there in 2013, but we were close, and in the 90s. Okay. Every time it went there and you bought the market, you made money with a 3-year view, and lots of money. Okay. So this market trades between 2 and 4 times book, mota mota. Actually 2.2 and 4.5 times book to be more precise. We're at 2.8, right? We're not at 3.6. 3.6 would make you much closer to 4.5. 2.8 makes you a little closer to 2.2. Can it drop to 2.2 and make a fifth type of 2.2 occasion? Of course it can. Do I see the circumstances around right now? No, I don't. Now, there are things that can go wrong, and I can start counting them, and they can go horribly wrong in the next 6 months, and we may even go and test that low. For example, the electorate in this country decides that I want a fragmented coalition government. The trade war with China, starts getting worse. The Fed continues to raise its rates because the labor markets in America are tight. and or we get an inflation scare globally, okay, because the Fed backs off, and growth in India falters. So that's the circumstances under which we get there. We attach a probability to that, maybe 30%, maybe 25%. So I think it's a good price to engage.
From whatever little I've spoken to people, seems to be hinging more on the labor markets being very tight and the Fed itself underestimating the pace at which it would hike rates. Should such a scenario occur, how bad could it be for EMs and India in particular?
See, I think EM has already taken the pain, okay? And if the Fed has underestimated inflation and has to hike at a faster pace, I dare say the US markets will take a bigger knock than EM from here on. So yes, it looks conventionally bad for EM, but I think because of the damage that EM has taken, if you look at relative performance and relative valuations, they're somewhere here, not here. So it's the US markets that are demanding, the multiple, not the EM markets. They're not trading at a demanding multiple. So I would think that if the Fed has got it wrong, probably be more wary about the SPX than the MSCI EM index.
And would that be actually positive?
But the absolute returns could be bad everywhere.
Okay.
Yeah, we're talking relative here. Yeah, but absolute returns could be bad everywhere. Policy errors are very poorly tolerated by markets. So if you're painting a policy error situation, then markets will not treat it well. At least not in the short run, on a 3 to 6 month time scale.
Good news, guys. Got a promotion and a damn good raise.
Congrats, beta.
Congrats, मेरी तरफ से भी.
From mama too.
वाह, raise? अब तो इंश्योरेंस पॉलिसी ले ले.
इंश्योरेंस? कौन सी कंपनी से लूं?
सोचना क्या? चूज वही जिस पर हो पूरा भरोसा.
वीरू, go for convenience. My company is online, quick and simple.
बेटा, but policy समझाएगा कौन?
वेबसाइट पे सब है पापा. I can even call and ask.
क्लेम सेटलमेंट का रेशियो क्या है? मेरी कंपनी का 98% से ज्यादा है.
That's good, but आज की generation wants everything online. Easy premium payment options, loan facilities और wide range of products.
अरे पापा दीदी, I will decide. Just send your links now. तुम दोनों भी ना. Same choice. LIC.
LIC ट्रेंडिंग विद टाइम्स 62 सालों से हर जनरेशन की पसंद.
Hello and welcome to Saal Mubarak, our annual show around the Diwali time when we speak to some of the best voices in the markets to try and figure out what could happen over the next 12 months, essentially from this somewhat to the next somewhat. And our very special guest today on Saal Mubarak this time around needs no introduction, Rhythm Desai of Morgan Stanley with me in our studios.
Relative performance and relative valuations, they're somewhere here, not here. So it's the US markets that are demanding, the multiple, not the EM markets. They're not trading at a demanding multiple. So I would think that if the Fed has got it wrong, probably be more wary about the SPX than the MSCI EM.
And hopefully the new year brings in a lot of cheer for everybody around.
Yeah, I think it will.
You think it will?
Yeah.
Back with Indian Open right here on Bloomberg Quint. The markets are absolutely flat. Now, two distinct and very important conversations to had with our next two guests. One, how the month of October has been with regards to the redemption pressures, if any, that mutual fund houses faced, both on the equity and the debt side and the liquid category as well. Viewers would remember that the liquid category was the one that had some pressures in the month of September. Two, what happens to the rollovers in the commercial papers for the NBFC segment that come out over the course of the next fortnight, arguably until Christmas as well? Saurabh Mukherjea himself was saying that a large number of redemptions or rollovers are coming up in the next 45 days. So what would fund houses' positions be as well? To talk about all of this and more, two very special guests, Radhika Gupta, the CEO of Edelweiss Asset Management, and Swarup Mohanty, CEO at Mirae Asset Global Investments. Both of you, thank you so much for taking the time out and being with us, and to you and your teams, from all of us here, a very happy Dhanteras. Radhika,
thank you for having us.
Yeah, pleasure having you. Radhika, let me start off with you first. How was the month of October? Because at the end of September, at the beginning of October, people were divided in the opinion whether the pain that we saw in the month of September would last and would actually worsen. I don't think that has happened, but how was October, both on the debt side and on the equity side?
Sure. So, Neeraj, a very happy Dhanteras to your viewers. As far as October is concerned, obviously, I think you saw a continuation of what happened in September spill into October. Now, as far as flows are concerned, there are three parts to it. There's equity, there's fixed income, and then there's liquid. Liquid saw, you would recall, a material outflow in the month of September to the tune of 1.5 lakh crores. And some of that is seasonal because of advance tax, and it comes back in October. What has happened is in October, money has come back. So about 50,000 crores odd has come back into the system, but it's not to the tune of the redemptions that you saw in September. So is that great news? Honestly, it's not. Money did come back, but it didn't come back wholeheartedly. In fact, a lot of it, I think, was left in the banking system. Second piece of news is around fixed income, which is the non-liquid category. Again, there in September, you saw outflows, and in October, you continued to see that trend of outflows. Obviously, it's been a rising rate environment. Plus, you know, there's been some challenge as far as some of the funds that had ILNF kind of exposure. So you saw about 20-odd thousand crores, as I understand, of flows going out of non-liquid fixed income. I think the good news is that the equity category, which is your retail equity flow, has remained reasonably stable. So at 8 to 10-odd thousand crores, which is where that number will probably close for the month, even accounting for a few large NFOs, I think retail equity flows were actually not that bad in the month of October, which is a very, very encouraging sign. And I think that's because of the fact that we have still today a large SIP book of almost 8,000 crores.
Swarup, a glass half full can also be always viewed as a glass half empty. I think Radhika makes some telling points, two worrying points. One, on the liquid category, while there has been inflow, it is not to the tune of the entire outflow that happened, or not even close to that number. And two, that the fixed income category continues to see outflows for 2 straight months. If I'm not wrong, and if I'm understanding Radhika's number correctly, the number in the month of October is probably higher in terms of outflow than on the fixed income category than what happened in the month of September.
I think what Radhika says is correct. Some amount of money which went out last month did not come in. That's whether it's right or wrong, I'm nobody to comment. The way I look at it from a mutual fund perspective is, see, it's a liquid category and it's meant to be money at call, which is supposed to go back. And I think from that perspective, the industry was tested last month. It continues to be tested this month on whether it can repay on time or not, and it continues to repay without flinching. Yes, the pressures have been there, especially on the liquid side. And there is a fair amount of uncertainty in people's minds, and I think people should have a little bit of comfort on that, on whether the money is parked in mutual funds can be got back or not. And I feel the industry stepped up the ante on that, and it's been able to pay on time, and it continues to do so. That's from an AMC perspective. Having said that, you know, what Radhika also points out is a silver lining on the entire thing is the equity side of the business, which is going robust day by day. There is a distinct change in behavior, both from the advisors and the investors, which is leading to this continued flow in spite of markets being topsy-turvy. If I remember right, if you went back just 4 or 5 years ago, this wouldn't have been the situation, but the conviction levels in equity continue to grow day by day. And I'm very happy to witness this within my working life because, finally the asset class of equity is the asset class of wealth creation, and people will make money if they are invested in the market. And if they're invested in markets like this, and that's coming out loud and clear.
Over the last few weeks, and there have been events which have started to make things look a little less gloomy. In light of that, Swarup, I'll stick to you. Does this instill slightly more confidence now than people had before? And then redemptions on their own can sort of see that little bit of a halt?
See, there is a question mark which has been raised by investors on the capability of certain issuers. To be fair to those issuers, they have come out very robustly in the market and are going about paying on time. There has been just one instance of Island FS not standing up to its commitments, but the rest have all stood up to its claims. We are seeing every day some kind of issue up for repayment, and it's coming through pretty seamlessly. So once this period is tested and it comes out clearly, I think the investor sentiments will come back. Yes, I think the issuers and the OMCs are working very closely to not let a sort of liquidity hangover being created, and that's will lead to more and more satisfaction to investors. It is that period. We are going through that, and I'm sure we'll come out of it fairly stronger.
Radhika, with the CP redemptions lined up till the end of the year, do you see more mutual funds redeeming or rolling over?
See, I think, I can't comment on individual funds, but what I would say is that, and just to echo what Swarup said, is that the MF industry has seen multiple liquidity crunches. We all remember the post-taper tantrum period in 2013. We see the period now. I think the MF industry has seen various liquidity crunches. I think each mutual fund house will take their own call as far as the kind of exposure they want to keep to some of the segments as far as HFC and NBFC are concerned in their portfolio. What I would re-emphasize is what Swarup said, is that right now, with the exception of one issuer, all the rollovers that are happening despite the noise are actually happening very smoothly. So from an AMC point of view, there's been nothing to worry about. AMCs are working hand in hand with issuers as relevant to make sure that things go through smoothly, and every amount of redemption every rollover is getting processed, and every redemption to a customer is getting processed despite the state of crunch. So we are actually in very, very safe hands from that point of view, and hopefully that will continue through the month of November. And if it does, by the way, I do feel like this little sense of panic or concern that happened around liquid funds and fixed income will ease itself. We're already seeing a few signs of that, and we'll probably be back to normal hopefully in the last quarter of the year.
Radhika, am I understanding this correctly, that despite the outflows that the industry by and large seems to be facing, you mentioned the fixed income in the liquid category as well, that's happened in the month of October, you, for now, as things stand, don't foresee a problem in the rollovers of the CPs that are coming in from NBFCs? There could be a select one or two which might, but by and large, you don't see problems.
I don't. In fact, there have been a number of rollovers towards the end of October. A number of maturities are coming up in November. And so far, so smooth. So everything has happened very smoothly up till now. And in any conversations, there's nothing one has been given to understand that should make one worried. Obviously, markets are very, very dynamic, and, things change on a day-on-day basis. But as of now, I think things have been happening very smoothly in the last week, and one was expecting that to continue over the next week or two as well.
Swarup, there was an article, and the reason why I can ask openly to the two of you is because the article seemed to suggest that there was inflows in the liquid category, I presume, of HDFC AMC, and the article seemed to suggest that bank-based AMCs are getting inflows where others are not. Is that as black and white as that?
Question to me?
Yes, Swarup.
Yeah, see, there seemed to be a distinct flight to safety from investors both at a retail level as well as the institutional level. Some segment of the institutional levels are now parking their money in CBLO and not coming back to the funds, as the flows this month suggest. So in what is safety is left to the perception of the investor. I mean, at the end of the day, it's safety of the portfolio rather than anything else. It's that period, as Radhika is saying, that, you know, this first 15 days of November will change a lot of things once most of the maturities come back to the funds and people realize that, things seem to be settling down. There was a rightful question when one large issuer defaults, and it should be questioned. There's no doubt or debate on that one. But it's up to funds and the issuers to respond in a collective manner, and I think they're going about doing that. At this moment, to answer your question, yes, there is a distinct flight to safety from investors, and I'm not singling out retail or institutional, from both sides. And that's reflected in some of the AUM movements that you're seeing across the fund houses.
I think it'll be really important as well to have that behavior coming in, because that gives a bit of a signal as well. If AMCs are able to roll over, and rightfully so, some of the papers that comes in, I think it just brings about a distinct change in the sentiment. If there was a sentiment indicator, I think it'll go up a few notches post the 15th of November once these dates go out. My final question, Radhika, to you, and that is on the silver lining, which is the equity flows. They stay stable, not without reason, but they stay stable. Do you reckon that those flows continue or pick up pace as the markets seem to be showing some signs of revival?
Flows will continue to be stable. I think, to echo what Swarup said, there's been a distinct change in investor behavior and more so advisor behavior. I think when you talk to good quality advisors across the country as one travels, you don't see a sense of panic. In fact, a lot of people talk about the fact that there is opportunity now, that customers are coming in at potentially better valuations. Also remember, Neeraj, a lot of the flow has come in through the SIP route, and that automatically reduces some of the element of volatility. So investor returns, while, you know, mid-cap and small-cap indices may have corrected 20-30%, investor experience has been a lot smoother. So yes, do I expect that number to continue? Absolutely, because so much of it is driven by SIP flow. And as he said, you know, over the last 3-4 years, there has been a marked shift in investor and advisor behavior, one towards sensible investing, and secondly towards broadly quality investing.
Radhika, staying with you, I mean, of the CPs that we're talking about that are up for maturing within these few months, about 42% are NBFCs and housing finance companies. With the measures that have been taken of late, do you see quality being an issue for any of the mutual funds, and whether or not there is a viable option for redemption and then reinvestment somewhere else?
So I think the mutual fund industry is not short of options. I don't think you can, because of a single issue that happened in September, write off a broader NBFC and HFC segment. Is there concern around the segment because of flight to safety and whatever happened in September? Yes. But is there anything wrong? Absolutely not. In fact, a lot of NBFCs and HFCs have gone back and done early buybacks of commercial paper in the last 2 weeks, which should give more confidence to the market. As funds choose to make the decision about rollover or not, I think good quality NBFCs, people will continue to roll over. There's no reason that they will not. Perhaps select ones mutual funds will not want to hold in their portfolio. That's an individual call. Even if they were not to, I think there are enough options outside that space for mutual funds to look at, outside the NBFC and HFC space. And this is a point of time where, for investors, I think safety is, as you know, is of the premium. So even if you're doing a couple of rollovers or fresh investments at slightly lower rates, I think funds will be comfortable with them. The more important thing is to give comfort to investors about the quality of our portfolios.
Swarup, do you agree with that? Because up until now, NBFCs, with the kind of growth that they have been showing over the last few years, have been one of the key drivers in most of the portfolios, even within the lending system itself. So for mutual funds to take a call on whether they want to divert funds is going to be a bit of a challenge.
No, I agree with Radhika on there being more options in the market. Having said that, you know, there is no financial report which is suggesting that there is a financial issue on the balance sheets of most of the NBFCs we invest in. It's a liquidity factor which has affected and created this situation. I think once the liquidity eases out, we will come back and reassess the situation. Yes, it's up to each fund house to realign their portfolios according to what they want their portfolios to look like, and depending on the risk profile of the fund itself. And that will play out. I don't see it much of a problem at this moment because there is a lot of talk, but at the end of the day, please understand, as Radhika rightfully pointed out, most of the issuers are coming out and prepaying it. In fact, most of them have come without a rollover option in the last 15 days just to show the comfort of their payment capacity. I will take it at face value, and if we are getting back our money on time, I will read it as that and not read too much more into it. So let time play through this, and I would like to conclude on anything as it stands. I mean, it is on a daily basis, especially the liquid fund investors who come in expecting the money to go out tomorrow, and that is being serviced as we speak. From our side, we've not seen a stress on the redemptions or rather, an issue with any of the issuers. We see a lot of maturities up till the mid of November, and we see all that being serviced. Having said that, if you look at the equity side, I think that's where the real play is. And from our side, we gave out a buy call last month, and it's been a fantastic call, as Radhika rightly pointed out, on the change in behavior of investors and advisors. People responded, and it was a great month for us last month on the equity side.
Okay, let's hope there are no bad events, if I can use that term. We need a happy festive season, and boy, we can use one this time around. Radhika, Swarup, thank you so much for joining in today and giving us your perspectives. And once again, to you and your teams, from all of us at Bloomberg Quint, a very happy Dhanteras and a very happy Diwali.
Yes, wish everyone a very happy Diwali. Thank you so much for having us.
Happy Diwali, guys. Thank you.
Thanks for joining in. Well, it's not turning out to be happy Dhanteras, though I must add. The broader end of the spectrum just having peppered with a few losses. Sun TV amongst the top losers, and OMCs are the top losers on the index as well. But I'm sure a lot of these stocks will be taken up on the FNO show. It's time up on this leg of Indian Open at least. So from Devina and me and the team that put this show together, thanks so much for watching. Stay tuned to Bloomberg Quint Live.